The biggest software stock comeback may already be starting, and most investors are still staring at the wrong part of the market. While everyone is obsessing over chips, data centers, and the obvious AI winners, some beaten down software stocks names are quietly setting up for a major rebound. Don't wait until the headlines say software is back, because by then the best entries may already be gone. And as you can see, I got a tier list ready, so I can rank these stocks based on upside potential, risk obviously, and how strong their balance sheet is. And if you're okay with taking a little bit more risk, you really got to pay attention, because some of the stocks will have a lot of upside potential, but because of their balance sheet or their risk profile, will be ranked lower on this tier list. Now for the first stock on the list, we got Zeta. I love this company, and if you've watched some of my previous videos, you can see that I do mention Zeta pretty often. In the 2026 portfolio video, 5 stocks hit rock bottom video, like I do mention the stock often, because they have a great business model, and they're growing very fast. But the unfortunate thing is, the last 5 days, the stock went up 27%. But a move like that obviously raises the question, is this still a good moment to buy the stock? The stock is trading at a price to sales ratio of 3.3 basically, which is not that expensive. Analysts are pretty bullish on this stock, with the most bullish price target aiming for $44. They're forecasting that their EPS will surge by 40% the upcoming 12 months, and their revenues 36%. Now if you're growing this fast, you deserve a much higher price to sales ratio in my opinion, especially if you're a software company. Now if you want to know if Zeta has still more upside potential, you got to go to my Mr. Invest sheet, and over there you will see the forecasted numbers according to analysts and the company their own guidance, and then you can see that the stock has the potential to basically surge 90% within the coming 3 years. So there's still upside for this stock, but it won't be your 10x stock like Micron. And now the big question is, where would I rate this stock on the tier list? And I will have to put it at B tier, because we got some very attractive software stocks coming up in this video, so that makes B tier the right place for Zeta. Now next up on the tier list, we got the stock Klaviyo. It's very likely that you've never heard about this stock unless you've joined the Discord, but they're basically a business to consumer CRM. Think of them as the brain behind how online brands talk to their customers. It helps businesses understand who their customers are, what they want, and when to reach them, all automatically. The positive point is that they have a strong financial foundation. They're sitting on $1 billion in cash, and the board recently approved a $500 million stock buyback program because the management is believing that the stock is undervalued. So that's always a bullish point. Revenue per employee is now over $600,000 per year. That is up 25%, meaning AI is making their team dramatically more productive and their business more efficient. And they're deepening their integration with Shopify, the world's largest e-commerce platform. If we take a look at the stock chart, they hit their all-time highs in February 2025, where the stock reached almost $50, and right now it's trading at $18.30. That's more than a 50% drop from all-time highs. And as you can see, the stock is up 25% the last 5 days. That's quite the move, but I'm forecasting that it has still some more room to grow. And as you can see in my Mr. Invest sheet, I'm forecasting that the stock has the potential to be $48 by the end of 2028, which is 160% upside from current levels. So if we look at the tier list, Klaviyo is a pretty safe stock. It has still quite some upside after the recent run, and that is why it deserves a spot in A tier. Now the next software stock on the tier list is called HubSpot. This one is also one of my favorites on the list. In the last 5 days, it went up 33%. But then again, if we look at the 3-year chart, it was sitting at $811 back in February 2025, and it got down all the way to $200. That's a 75% drop from their all-time highs. They are also trading at a price to sales ratio of 3. Analysts are not that excited for this stock, but they're expecting that their EPS will surge by 37% and their revenues basically 20%. Those are very impressive numbers. Again, all this is visible in their EPS chart and their revenue chart, which looks insane. Now, if we're going to take a look at their business model, they operate similarly to Salesforce, but they're more focused on small to mid-sized businesses. And the beautiful thing is that they build a moat which is hard to replicate, because they're offering a unified platform where marketing, sales, customer service, and data all live in one place. And this eliminates the headache of stitching together 5 different software tools. And another very bullish point is that the board authorized for a $500 million share buyback program in 2025. I covered this stock very recently in this video, where I talked about 7 destroyed stocks that insiders bought, and one of those stocks was HubSpot, so they got also a ton of insiders buying the stock, which is another very bullish signal. And if we take a look at the Mr. Invest sheet, you can see that the company will likely grow their revenues 15% on average for the coming couple of years. Now, software stocks obviously deserve higher PE ratios, but if we're being conservative and give it a PE ratio between 30 and 40, which is very reasonable if you're growing your revenues 15% on average, that will mean that the stock will likely be between $560 and $750 by the end of 2028. That's, let's say, a 160% increase from current levels, which is quite some upside. And this is another pretty low risk stock. stock, and that is why it deserves a spot just behind Klaviyo in the S tier category. Next up we got a stock that you probably heard of before, and it's called ServiceNow. Let's take a look at what this stock has done the last 3 years. So their all-time highs were at $225. Their all-time lows were at basically, I'm pretty sure, $80. Yeah, there we go. Let's say $90. And in the last 5 days, it made a move up 36%. That's quite impressive. But if you take a look at the larger picture, it's still down quite a lot. But the most important question is, it's still trading at attractive valuations. Well, they're trading at a PE ratio of 80, which is quite expensive. They're trading at a price to sales ratio of 8. Analysts got a mixed opinion about this stock, and they're forecasting that their EPS will surge 5% in the coming 12 months, and their revenues 22%. But let's take a look at their business model. ServiceNow is basically a cloud-based platform that helps organizations manage and automate their business process and IT operations. And who are using their software? Mostly medium to large size enterprises like banks, hospitals, governments, tech companies. Management is targeting over 30% of all new contracts to come from AI products by 2030. On top of that, ServiceNow closed a $7.75 billion acquisition of Armis, a cybersecurity company, adding security intelligence directly into their platform. And to top it off, ServiceNow announced a $2 billion accelerated share buyback program. Management official target is $30 billion in subscription revenue by 2030, and they've called that the conservative bear case scenario. Now, if you take a look at my Mr. Invest sheet, reaching $31.5 billion in 2030, because the $30 billion target was pretty conservative, and in my opinion, this target is also very conservative, but that shows you that the stock will likely hit between $240 and $300 in less than 3 years. It's not a massive multi-bagger, but it's definitely a decent and very safe investment, and that forces me to put it at the same spot as Zeta, and that is a very decent spot at B tier. Next up we got a stock that might have a little bit more risk attached to it, but on the other side got quite a lot more upside potential. So this is a perfect stock for investors that can deal with a little bit more risk. And just today the company completes the acquisition of Cubra, and they've raised their full year 2026 outlook from basically $340 million to $500 million in total revenues. That's basically a 30% increase in their 2026 outlook, which is pretty massive. And unfortunately, this is not visible on their website. It's still showing their old numbers. Analysts are also pretty bullish on the stock, and the company is right now trading at a price to sales ratio of 1, which in my opinion is pretty cheap. Over the last 3 years, the stock is down more than 60% from its all-time highs. And yeah, look at their EPS chart and their revenue chart. It's going in the right direction, and my Mr. Invest sheet does have the updated forecasted numbers. You will see that very soon. The upside is quite compelling. But what is this company actually doing? Repay Holdings is a payment technology company. They help consumers and businesses make electronic payments. Think debit cards, credit cards, digital wallets, all that kind of stuff. They serve two main customer groups: the everyday consumer, like loan borrowers, and businesses. But this is the biggest reason to be excited about Repay right now. The deal to acquire Cubra is expected to expand its reach to more than 40% of US and Canadian households every month. Now, while the net income number looks negative, that's mostly due to accounting charges. The real cash generation is solid. And what makes this stock interesting is that Forager Capital Management, which owns about 13% of the company, made a public all-cash acquisition proposal at $4.8 per share, representing a 75% premium to where the stock was trading before the announcement. Even if that specific deal doesn't go through, it tells you something important. A major insider believes that this company is worth far more than the current stock price, and this is one of the strongest signals that a stock is undervalued. And as you can see over here, very recently in March and April, insiders have been buying this stock. 2 million, another 2.4 million, 2.3 million. That's a very bullish signal. Now, if we take a look at my Mr. Invest sheet, over here you can see the updated forecasted numbers. And you can see that I'm only attaching a PE ratio between 10 and 20. But it's reasonable because they're only expected to grow their revenues around 6 to 7% from 2028 to 2030. But listen, let's take a PE ratio of 15. That means that the stock could hit $16 by the end of 2028, which means a 300% upside from current levels. That's a very appealing investment, but I got to say their cash position is not that strong because it represents only 18% of their market cap, with some substantial remaining debt, which is not that strong of a balance sheet, and that makes this stock a higher risk investment. But to be honest, it's still a great deal. So yeah, if you remember, Klaviyo and HubSpot had around a 160% upside from current levels. Repay got a potential 300% upside by the end of 2028, but obviously with more risk. And that is why I got to put it behind behind Klaviyo and HubSpot, and it's not that big of a risk that you would put it at B tier or D tier. So I would give it a very nice spot on A tier. Next up we got another stock that is a little bit controversial and also got some risk attached to it, and it's called Rezolve AI. Rezolve AI and Repay are two stocks with the most risk out of all the stocks on this tier list, but they also got one of the highest potentials. At one point this stock reached $7.7 in September 2025, but now it's down all the way to $3. That's more than a 50% drop from its all-time highs. There are 6 analysts covering the stock, and they all seem to be pretty bullish, with an average price target of $10.7, which is a 270% upside from current levels. This is not showing their EPS and revenue forecast, but fortunately I got it in my Mr. Invest sheet. They're expecting a positive EPS in 2028. Rezolve AI has the potential to be a $7 stock based on PE ratios, but if you base it off price to sales ratios, knowing that they got 120 million shares outstanding and these revenue numbers, you can easily attach a price to sales ratio of 5. That means that the stock could be $33 by the end of 2028. That's a 10x, guys. That's no joke. But this obviously comes with a higher execution risk, so it's very important to understand the business. Now, if I had to place it on my tier list, I just gotta put it at S tier. The risk reward profile is just so compelling, and I am willing to take that risk, but this is obviously not financial advice. If you're a little bit older, or if you just don't like risk in general, I would probably put this stock at B tier or A tier, but in general, I would say it's worth the risk. Next up on the list, we got Pagaya and Upstart Holdings. I want to rate these together because these have very similar business models, but the crazy thing is that Pagaya's business model is less risky and has more upside potential. But don't forget, Upstart is still a phenomenal company. Now let me explain why. Pagaya is trading at a PE ratio of 14, Upstart is trading at a PE ratio of 76. But to be fair, they're expected to grow their EPS 60% in the coming 12 months and their revenues 34%, which is quite impressive, and that is justifying their 76 PE ratio. But if you take a look at Pagaya Technologies, they're forecasted to grow their EPS 13% and their revenues 10% basically, which is obviously a lot slower than Upstart Holdings. But if we take a look a little bit more into the future, you can see in my Mr. Invest sheet that Upstart has the potential to be a $128 stock by the end of 2028, which is a 280% upside, which is still insane. While Pagaya is only forecasted to grow at on average 12%, it is showing us that Pagaya has the potential to be a $90 stock by the end of 2028, which is a 475% upside from current levels. That is really showing you the brutal upside potential for Pagaya. But what are their actual business models? Upstart connects borrowers to banks using AI to replace FICO scores. Basically, banks get better loan decisions and consumers get faster approvals. 91% of loans are fully automated, which is giving Upstart very high margins. While on the other hand, Pagaya, very similar to Upstart, is approving borrowers that lenders would otherwise reject. It focuses on a second look at loans. But as you see over here, Pagaya has a very strong balance sheet. 43% of their cash is representing their market cap, and for Upstart that's only 32%. And they got $1.9 billion in borrowings. Now if I had to rank them on this tier list, I would put them at S tier, but I would put Pagaya above Upstart, because if interest rates stay higher for longer, Upstart will be hurt more compared to Pagaya's safer business model. Next up we got PAR Technologies. This is another excellent software stock focused on the restaurant business. If we take a look at their stock chart, the company is down 75% in the last year. That's a shocking number and a very ugly stock chart. The company is trading at a price to sales ratio of 1.3. 10 analysts seem to be pretty bullish, with an average price target of $28, which is a 70% upside from current levels. Their EPS is forecasted to surge 290% and their revenues 10%. This is very clearly visible in their EPS chart, which is looking beautiful, and their revenue chart. But what is this company actually doing? PAR Technology is the operating system for restaurants and retail chains. Think McDonald's, Burger King, and other large chains. They provide everything a multi-location restaurant needs. Think of them as the brains behind the counter at your favorite fast food restaurant. The best thing about their turnaround is that this company is shifting away from one-time hardware sales to recurring monthly subscriptions. Another bullish point is that the board authorized a $100 million share buyback program, which will improve their EPS by a lot. And as you can see, on 14 May 2026, an insider bought $10 million worth of shares. That's a very bullish signal. Now, if we take a look at my Mr. Invest sheet, you will be able to see that they will likely grow their revenues around 10% for the coming 3 to 5 years. And that would easily give them a PE ratio between 15 and 25. Now, let's say you give them a PE ratio of 20. That means the stock has the potential to be a $40 stock by the end of 2028, which is a 150% increase from current levels, which shows you the stock has a very decent upside. Now that we know this stock has the potential to increase by 150%, and there's a share buyback program and all that kind of stuff, itself, it's definitely deserving a spot at B tier. Would I put it over Zeta and ServiceNow? I personally wouldn't, because it's still in the restaurant business, and restaurants generally have lower margins, so less money to spend on technology. And because of that, I'm putting it at the end of B tier. Now, next up, I got another two stocks I want to rank at the same time, and those are SoFi and Nubank. Both very similar business models, but one of them is operating in only America, and Nubank is mainly focusing on Brazil, Mexico, and very recently trying to get market share in the United States. Both of these stocks are forecasted to grow very fast in the coming years. SoFi is forecasting a 40% increase in their EPS and a 30% increase for their revenues, while trading at a PE ratio of 40. And at the same time, Nubank is forecasting that their EPS will surge by 60% and their revenues by 47%, even faster than SoFi, while it's only trading at a PE ratio of 20. Just imagine that, that's absolutely crazy. Both of these are phenomenal stocks and are now trading at a pretty nice discount compared to their all-time highs. Here you see SoFi, now trading at $18, and here you see Nubank, now trading at $13, down from $18 at their all-time highs. These are, by the way, both fintech companies, if you haven't heard of them before. In my recent videos, I keep repeating that Nubank and SoFi are very attractive buys right now. And if we take a look at my Mr. Invest sheet for Nubank, I'm forecasting these numbers, and that is showing us that this stock will very likely be between $48 and $64 by the end of 2028, which is basically a 350% increase from current levels, which is a very attractive upside. And if we take a look at SoFi, this stock is very likely to be a $55 stock by the end of 2028, which is basically a 200% upside from current levels. If we compare Nubank to SoFi, SoFi's cash is representing 16% from their market cap, and for Nubank that's 19%. And that is showing you that Nubank got a stronger balance sheet, but it's operating in Latin America, which is increasing the risk of an investment. So I would say the risk profile is basically the same for both companies, but we just saw that the upside for Nubank is higher, and that's why I just have to rank Nubank above SoFi, and they both deserve a spot at S tier. And finally, we got MNTN, another very attractive software company. Let me just show you the numbers. The stock is, as you can see, down more than 60% in the last 3 years, now trading at $10.7. They're trading at a PE ratio of 36. They're trading at a price to sales ratio of 2.3. 10 analysts seem to be pretty bullish on this stock, with an average price target of $20, which is an 86% increase from current levels. They're forecasting that their EPS will surge by 130% and their revenues 20%. And their EPS chart is visualizing this. Same counts for their revenue chart. Now, what is MNTN actually doing? What is their business model? Well, they're basically a technology platform that brings performance marketing to connected TV. Think streaming services like Hulu, Peacock, and others. They basically let businesses run TV ads that actually work like digital ads. You can target specific people, track results, and measure exactly what you're getting for your money. Just think about it. Usual TV advertising got the same ads showing for every single person, but now they will be able to personalize the ads differently to every single person, just like Meta with Instagram and Google with YouTube. And the TV advertising is one of the last big ad markets to go digital, and MNTN is positioned right at the crossroads. The stock is trading at a forward PE of only 8, and in my Mr. Invest sheet you can clearly see that the stock has the potential to be a $39 stock by the end of 2028, which is representing a 260% upside from current levels. And the great thing is that they have a very strong balance sheet. Their cash pile is representing 25% of their total market cap, and they got no borrowings. And if I had to rank it on my tier list, I would have to put it at the top of A tier, and that makes this tier list complete. Now, if you found this video very useful and you discovered some very new interesting stocks, please do me a favor and smash that like button. I'm still a small channel and I would really appreciate that. It would help me out a lot. And I would suggest watching my most recent video where I talked about 6 stocks in the 4 best sectors of the economy, which are gaining traction right now as we speak. So don't miss out on those, and I will see you guys over there.